Your safe Muni bond is a landmine, and it's your tax dollars on the hook. Your safe, tax-free Muni can make you pay twice. First when your bond price drops, then when your property taxes and fees rise to plug the same hole. Start with the numbers. U.S. public pensions sit on roughly $1.35 trillion in unfunded liabilities, with a current national funded ratio around 81.4%, and anything under roughly 70% is a red flag threshold for stress risk. When that promise crowds budgets, the sequence is brutal and predictable. Pension pressure, contribution spike, budget triage, downgrade, spreads widen, your portfolio marks down, your tax bill goes up. That AAA feeling fund? It priced the tax break, not the risk. Today we pull the pin on pensions, geography, and demographics, and hand you a 3-step audit you can run now. Why now bridge? Problem, urgency, promise. Here's the setup. Inflation raised the cost of everything cities buy, higher rates raised the cost of every dollar they borrow, and tight labor markets forced bigger pay just to keep police, teachers, and sanitation on the job. Meanwhile, investment returns that once papered over pension promises are volatile, and federal pandemic backstops are fading. Local budgets are getting squeezed from all sides at the same time. Muni safety? Most prices are telling you what the tax exemption is worth, not whether the issuer can keep paying through a rough decade. A municipal bond is your city's IOU. A pension promise is the second mortgage you didn't see on the listing. When that mortgage balloons, everybody in the house feels it: bondholders, employees, and taxpayers. Downgrades don't just bruise egos. They raise the rate on every new school, road, and water project. The extra interest isn't abstract. It gets collected in mill rates, sales taxes, utility fees, and temporary surcharges that tend to outlive their purpose. If you own local bonds, you're doubly exposed: portfolio pain now, higher living costs later. So why now? Because rates are still high by last decade's standards, climate shocks are more frequent and expensive to insure, and outmigration is shifting tax bases across the map. Research groups warn that homeowners' insurance premiums are up roughly 21% since 2015, and major carriers are retreating from wildfire and flood corridors. S&P has cited climate exposures in outlook shifts and downgrades, including after the 2017 to 2018 California wildfire seasons, where economic losses approached $250 billion, and analysts expect adaptation to drive materially higher capital needs that could plausibly double Muni issuance by the mid-2030s. Policy shops note state-level tax caps that limit revenue flexibility. That mix turns small structural problems into big, compounding ones. The premium you accepted for tax-free may be a discount to the real risk. The tax break was priced, the risk wasn't. Watch the pattern before it hits you. Pension pressure, contribution spike, budget triage, downgrade, spreads widen, your portfolio marks down, your property taxes and base utility charges rise. That's the loop we'll break today. Here's what you'll get today: how pensions override bond math even when budgets look balanced, how geography and demographics quietly move your credit risk, and a simple 3-step audit: credit, geography, revenue source, you can run in an hour. We start where the balance sheet lies most convincingly: pensions. The shadow ledger and the budget mirage. Pension mechanics that break balanced budgets. To understand Muni credit, follow the promises. Pension obligations sit ahead of almost everything else in practice, and often in law. They don't come due like a bond maturity. They seep into budgets through rising annual contributions that crowd out revenues that would otherwise fund services and debt. Here are the mechanics. The liability is valued using an assumed return, roughly 7% at many plans, which shrinks today's reported obligation. If that assumption is optimistic, the real obligation is larger than it looks. Plans smooth market losses over years and amortize unfunded liabilities over long horizons. That keeps this year's payment low while extending the pain, like paying the minimum on a credit card. On a cash basis, a city can claim a balanced budget. On an accrual basis, the pension promise grew with every paycheck and under-delivered return. Audited notes tell you the truth: funded ratio, assets/liabilities. The 5-year record of paying 100% of the actuarially determined contribution, ADC. The discount rate sensitivity, a 1-point drop that blows a hole, is a red flag. An amortization policy, closed and shorter pays principal, open and rolling punts it. Today's national context. Plans average about 81.4% funded. Issuers below roughly 70% are in the red flag zone. Legal and practical seniority matters. In several states, courts treat pension benefits as contractual rights that are hard to cut. Bonds, by contrast, are promises subject to appropriation and politics. Even without explicit legal ranking, the political economy pays pensions first. When pressure hits, who gets paid tells you the truth. Now the budget impact. When ADCs step up, after weak returns, actuarial changes, or payroll growth, the general fund must find cash, cut services, raise taxes, defer capital, or accept higher borrowing costs. Ratings language shifts to rising fixed costs and limited revenue flexibility. The next sale clears at a wider spread, adding interest expense to the same stressed budget. Maintenance slips, future infrastructure bills grow, the hidden liability behind the headline balance. Underassumed risk creates mirages elsewhere. Higher market rates can improve funded ratios mechanically by lowering the present value of liabilities, even if assets didn't improve, masking fragility. Alternative assets with lagged marks smooth volatility until they don't. When private values catch down to public reality, the ADC ratchets up on a delay. The squeeze compounds. Taxpayers resist hikes, some leave. Property values stagnate when services slip, softening the base. Sales taxes slow as households cut back. To preserve services, officials may underpay the ADC or issue pension obligation bonds, timing bets, not fixes. Research and ratings work show that underpaying ADCs and using long, open amortization schedules correlate with future stress. What matters to you is sequence and price. Prices gap down on outlook changes and headlines about contribution spikes. Liquidity thins, brokers widen bid-ask spreads. Funds meeting redemptions sell what they can, not what they should. You haven't missed a coupon, but your total return turns negative. The balance today illusion is common. Capital plans push expensive projects to out years at stale costs. Levy limits cap how fast revenue can rise even as fixed costs surge. Councils pivot to workarounds, special assessments, temporary public safety levies, higher base utility charges that don't count as taxes. Residents feel nickel and dimed. Infrastructure ages. Insurance shocks worsen it. Premiums rise in hazard corridors. Carriers retrench. Disposable income shrinks. Assessment appeals climb. And the same pension dollar consumes more of less. Your defense is discipline, not hope. Read the pension notes before the budget deck. Look for closed amortization, lowered discount rates, and 5-for-5 ADCs. Scan the sensitivity table. If a 1-point drop explodes liabilities, shade your risk darker. Check reserves against written policy and a history of replenishment after draws. Verify adaptation and maintenance are funded now, not stacked in year 4 and year 5. If assumptions and amortization choices borrow from tomorrow, treat the surplus as a mirage. The question isn't, will they default? It's, what will it cost everyone to avoid it? If the answer is more taxes, fewer services, delayed maintenance, pension math already overruled bond math. Score the pension first, price the bond second. Geographic risk, climate, insurance, and infrastructure shock. While pension math seeps through budgets, geography can flip the ledger in a single season. Climate shocks don't just wreck assets, they reshape operating budgets overnight. A storm surge floods streets, a wildfire jumps a ridge, a heat dome strains power and water systems. The bill arrives before FEMA paperwork is filed, and the clock starts on debt, overtime, and emergency repairs. Cities can defer pension pain. They can't negotiate with a washed-out bridge. Here are the stakes. Capital plans assume lifespans and steady upkeep. Climate compresses those timelines. A once-in-100-year flood now tests levees twice a decade. Each hit means overtime, debris removal, temporary shelters, and then the expensive part, rebuilding to higher standards. Bond-funded resilience stacks on existing debt, just as insurance premiums climb and tax bases wobble. You pay twice, once in portfolio marks, again in fees and levies on your bill. Action looks like this. A river city's spring crest overtops old berms. Roads heave, pumps fail, the water plant runs on backup generators. The emergency reserve covers the first weeks. FEMA reimbursement takes months and doesn't make everyone whole. The council accelerates a resilience bond, new pump stations, elevated substations, higher flood walls. Underwriters request a climate appendix. Rating analysts ask for updated flood maps, local cost share, and insurance assumptions. The sale clears at a concession. Debt load rises. Operating budgets inherit bigger maintenance lines. Meanwhile, insurers are retrenching. Premiums jump in wildfire and flood corridors. Some carriers leave zip codes entirely. State residual markets fill gaps at higher prices. Homeowners face renewal shocks. Landlords pass costs into rents. Assessment appeals climb. The property tax base slows just when adaptation needs cash. A few employers edge to higher ground. The city's map of who pays starts to shift away from its most vulnerable neighborhoods. Impact arrives in layers. A water authority's chemicals, energy, and pump replacements cost more. To protect coverage on revenue bonds, the board passes a base charge resilience increase. Ratepayers feel it monthly. The general fund leans on permits and fees to avoid state levy caps. Temporary disaster surcharges extend another year, then another. Spreads widen for issuers clustered in hazard maps. Not because default is imminent, but because the path to staying current is steeper. Here's the twist investors miss. Federal cost share isn't a blank check, and it often requires local dollars up front. If the issuer can't post its match, projects slip. Delayed adaptation compounds risk and cost. A substation that should be relocated gets sandbagged again. A coastal road that should be raised is patched after every king tide. Each stopgap raises operating costs and the odds of outage. While that's unfolding on coasts, wildfire belts face their own math. Extended drought dries fuels. A wind event turns a canyon into ignition. A rural district's volunteer force can't keep up. Mutual aid helps, but the rebuild is scattered and expensive. Insurance withdrawals hit lending. Mortgage originations slow without affordable coverage. Assessed values fall on damaged parcels and stall nearby. The district still owes pensions and retiree health care. It issues certificates for engines and station hardening. Investors demand stronger covenants, higher coupons, and clear risk maps. The deal sells. Ratepayers shoulder special assessments that don't expire with the smoke. Heat shows up differently. Peak demand strains grids. Water systems fight algal blooms and pipe bursts from ground movement. Cities add shade and cooling centers. Transit slows to protect equipment. The costs don't headline like a hurricane, but they accumulate. Power and water credits with true rate-setting autonomy handle it better. Boards vote mid-year adjustments. Coverage stays at or above about 1.5x through stress, and reserves replenish. General funds boxed in by levy limits juggle fees and service cuts. Disclosure quality separates names. Some issuers publish hazard overlays, climate-adjusted reserve targets, and funded projects tied to risk maps. Boston's recent bonds included detailed sea level exposure and the climate-ready plan. Investors could trace dollars to defenses. Others recycle boilerplate. When the appendix is thin, spreads tell you the market doesn't trust the plan. Meanwhile, in high-risk corridors, premiums have climbed about 21% since 2015, and carriers have withdrawn from some wildfire and flood zones, pushing borrowers into pricier state backstops, pressure that flows into assessed values and sales taxes. What nobody priced early enough was the insurance shock spillover. As premiums rose roughly 21% nationally since 2015, and 20% to 40% in some hard-hit areas, disposable income fell. Sales tax softened. Home sales slowed, new permits dropped, shrinking impact fees. Carriers reduced exposure or exited certain wildfire and flood zip codes, shifting borrowers to higher-cost residual markets. Cities issued more debt to bridge timing gaps, raising leverage while the base weakened. Ratings held in many places, but outlook language started to include exposure to physical risks and uncertain insurance markets. Your screen is simple. Pull hazard disclosures in the latest official statements: coastal surge, riverine flood, wildfire, extreme heat. Look for climate-adjusted reserves and named projects with schedules and identified matches. Check whether adaptation is front-loaded or punted to out years. Analysts expect adaptation to require materially higher capex and could plausibly double Muni issuance by the mid-2030s. So unfunded wish lists are a tell. Read whether the issuer has authority to raise rates quickly. Revenue bonds for essential services with proven coverage, at least about 1.5x through stress, and political room to move fare better than general funds under caps. Then layer insurance dynamics. Are major carriers retreating? Are state backstops solvent and priced to risk? If households can't insure at reasonable rates, your property tax base, assessed values and turnover, is at risk. If businesses face frequent closures from heat or smoke, sales taxes wobble. If flood maps are outdated, ask what happens when they're revised. Finally, separate adaptation funded by debt from denial funded by hope. Debt plus a credible plan, reserves, and pricing power is workable. Debt without a plan is a warning. Geography clusters risk, your portfolio shouldn't. Demographic decay, shrinking tax base, rising fixed costs. While climate redraws risk maps, people flows rewrite ledgers. Demographics decide who pays, how elastic that payment is, and whether fixed promises get lighter or heavier relative to the base. When wage earners leave or age out, costs don't politely follow. They stick and sometimes rise. Here are the stakes. Outmigration drags sales taxes and income-related revenues. Property tax depends on assessed value and transactions. Both soften when young families stop bidding. Aging populations shift spending and raise service intensity. EMS, public health, senior transit, without expanding the tax base. Pensions and retiree healthcare don't shrink on cue. Actuarially determined contributions keep stepping up even as covered payroll flattens. You get a structural squeeze, fewer shoulders, heavier loads. Action starts in a post-industrial county, already losing employers to automation and relocations. Young workers follow jobs across state lines. Enrollment falls, but not fast enough to let the district close schools without blowback. Appeals succeed on half-empty office buildings. Residential turnover slows as mortgage rates pin owners in place. Sales tax receipts flatten. The pension contribution rate rises as a share of payroll because payroll isn't growing. The county caps hiring, trims routes, and leans on fees that fly under state levy limits. Ratings analysts flag narrowing revenue flexibility amid demographic headwinds. The phrase sounds clinical. It's a warning. Unknown to council members across town, the region's anchor hospital shrinks inpatient beds and expands suburban clinics. Downtown lunch crowds thin, parking revenue misses, and a tax increment district underperforms. The city backfills debt service from the general fund. The pension bill doesn't care, it's due. A quiet outflow becomes a budget story, then a credit story. Impact lands in layers. Houses age without reinvestment. Assessment growth trails inflation, which means real capacity erodes even if nominal numbers inch up. Streetlights fail in pockets, curbs crumble. Private capital prices that decay. Mortgage credit tightens, turnover slows, and comps stall. Councils push temporary levies for public safety and raise base utility charges to protect revenue bond coverage. Residents feel the squeeze monthly. Investors see spreads drift wider. Both are right. Here's a micro story. The school board meets on a Wednesday night. Enrollment is down again. The finance director proposes consolidating 2 underutilized buildings next fall. Parents object. The board delays again. The district keeps paying for heat, buses, and staff for empty seats. The GO rating stays investment grade, but the outlook slides to negative on structural imbalance risk. By Friday, the district's refunding guidance is 40 basis points wider. The tax bill will cover the difference. While that unfolds, a bedroom suburb that boomed during remote work stalls. Sales volume collapses as owners sit on low-rate mortgages and new families can't clear affordability. School rolls surprise to the downside. Fixed admin costs don't flex. The town's main lever is property tax, but a state levy cap limits increases. Leaders push a referendum to exceed limits for operations. It passes barely. Investors applaud willingness but note a thin margin, a sign future hikes will be harder. The reserve policy looks fine. The replacement cycle for roads and pipes still looms. Slower growth meets rising wear. University towns show the nuance. A flagship campus stabilizes demand, but if enrollment plateaus or international students dip, auxiliary revenues soften. Town-gown agreements determine who pays for police and fire. If the university's property is largely tax-exempt, the base skews to rentals with cap rate volatility. A strong pilot agreement buffers. A weak one shifts costs to homeowners. Investors price the difference in basis points. Contrast with a diversified metro pulling in migrants. Assessed values grow, incomes rise, dependency ratios improve. Pension contributions shrink as a share of revenue, not because promises changed, but because the denominator grew. Essential service revenue bonds shine here. Expanding payer bases, true rate-setting autonomy, coverage consistently at or above about 1.5x through stress. Demographics can be a credit shield if you own the right cash flows. What nobody priced early enough. Immigration offset domestic outflows for a time, then cooled. Regions counting on persistent inflows hit a stall. Rents loosen, permits fall, construction-related fees dry up. County hospital districts see uncompensated care climb as populations age and insurance costs rise. Their levies carry more weight. Outlook language adds rising fixed costs amid slower base growth. It's the same math again. Your screen is straightforward. Pull 5 and 10-year population trend lines. Avoid single-year noise. Break by age cohorts. The over 6'5" share rising without a matching increase in working-age residents means lower elasticity. Track dependency ratios. More non-workers per worker narrows capacity. Check assessed value growth versus inflation. Sub-inflation growth erodes real room. Read state tax and levy limits. Hard caps choke. Flexibility when you need it. For school districts, monitor facility utilization. Empty seats are an unfunded liability with buses attached. Then tie it to pensions and OPEB. If the contribution rate is rising against flat payroll, that math rolls directly into the general fund. Look for employers paying 100% of the ADC and adopting lower discount rates and closed, shorter amortization schedules. Those behaviors counter demographic drag. Wishful assumptions amplify it. Finally, map economic concentration. One dominant employer or sector, refining, paper, a single hospital system, raises correlation risk. A layoff or policy shift can hit assessed values, sales taxes, and utility loads at once. Places with healthcare, higher ed, logistics, tech services, and government anchors absorb shocks better. Bedroom communities reliant on commuters and homeowners with little commercial base are stable until they're not. When transactions freeze, their main lever is the rate you pay. Demographics won't default a bond next quarter. They will decide who pays, how quickly, and at what political cost. Own issuers where the math of people supports the math of promises, or size the risk like you'll be the one plugging the hole. Fund-level trapdoors, concentration, style drift, and yield chasing. Funds promise simplicity, diversification, daily liquidity, and professional credit work. The trap is what those words hide when markets move. You don't own a ladder, you own a manager's habits. In stress, those habits write your outcome. Start with concentration. A national fund can quietly stack 20% to 35% in one state because issuance is lumpy and big states dominate supply. Layer sector tilts, hospitals, senior living, land-secured deals, and your risk rhymes across issuers that share the same payer mix, labor pressure, or housing cycle. That's why a single state's legal change or climate shock can ripple through a fund that looked diversified on a pie chart. Now style drift. Mandates say intermediate and investment grade. The holdings file says longer calls, more BBBs, and unrated specials that pay a little extra. It's subtle. One new deal adds 10 basis points of yield, then another. Over a year, duration stretches, call exposure climbs, and the credit mix slides downscale. In calm markets, nobody cares. When rates jump or spreads widen, extension risk bites, and the intermediate fund behaves like a long fund at the worst time. Yield chasing is the accelerant. Managers compete on distribution rates, so they add premium callables, venture into thinly traded names, or lean on high-yield sleeves inside an otherwise IG wrapper. It works until it doesn't. In rising rate regimes, calls don't get exercised, maturities extend, and mark-to-market losses overshoot what the fact sheet implied. In outflow waves, funds sell their most liquid bonds first, the good stuff, leaving a weaker portfolio for those who stay. Liquidity mismatch is the quiet killer. Daily liquidity funds own bonds that take days to move at fair prices when the tape is thin. If redemptions surge, managers use cash, then sell liquid paper, then tap lines of credit, and in some cases redeem in kind. NAVs look stable until the high-quality cushion is gone. Performance lags peers, prompting more redemptions. It's a feedback loop that has nothing to do with your horizon and everything to do with other people's panic. Hidden leverage shows up in tender option bonds and derivatives. TB programs borrow short to buy long munis, boosting yield in good times and forcing unwinds in volatility. Prospectuses disclose it, fact sheets don't headline it. When rates move fast or credit gapes, deleveraging turns a drawdown into a skid. You didn't sign up for leverage, you owned it anyway through structure. Insurance wrappers can lull you. An insured CUSIP sounds safe until the insurer reprices climate or litigation risk across its book. If confidence fades in the wrapper, the market looks through to the underlying credit. Funds that never underwrote the obligor are now passengers. The wrapper buys time, not immunity. Fees matter more than marketing suggests. In low-yield worlds, a 60 to 80 basis point expense ratio eats a big chunk of after-tax income. To defend a headline yield net of fees, some managers creep down the quality curve or out the curve. The drawdown you feel later was born in the fee line today. So what do you check? Pull the full holdings file, every line, not just the top 10. Add up state weights, cap any one state, especially where you live. Tally sector exposure, hospitals, senior living, land secured, tobacco, transit. Compare average duration to the stated benchmark and mandate. A big gap is drift. Flag callable share and next call clusters. Bunching means extension risk on one date. Count BBB and below. Look for unrated buckets. Search the statement of additional information for TOBs, derivatives, and redemption in-kind policies. Then stress test behavior. How did the fund do in the 2013 taper tantrum, March 2002, and the last rate spike? Did they raise cash before outflows, or chase yield into the sell-off? Did duration stay within band, or creep? Did BBB exposure jump in a quarter? Pattern beats pitch. Microstory. A popular high-yield muni fund runs 12% in one state, wrestling with levy caps and wildfire risk. It layers hospital credits at thin margins and a sleeve of land-secured paper. When insurance premiums jump and a regional system posts weak results, spreads widen across the sleeve. Outflows start. The fund sells its AA water and sewer to meet cash, leaving more of the BBB sleeve behind. Distribution holds for a quarter, then gets cut. The NAV never bounced the way you expected because the good collateral left first. Practical fixes are boring and effective. If you need funds, pick national, high-quality mandates with explicit caps on state weights and BBB exposure, tight duration bands, and minimal TOB usage. Favor managers who publish full holdings monthly, show stress histories, and keep dry powder into volatility. Low fees buy you patience. If you can build separately, run a ladder of essential service revenue bonds with clean calls and verified coverage. Either way, don't rent yield you can't underwrite. The Taxpayer Contagion. How downgrades hit your wallet. A downgrade starts as a sentence in a ratings note and ends as a line on your bill. The stakes are immediate. One notch lower means higher coupons on every new school, road, and water project. That extra interest isn't theoretical. It's collected in mill rates, base utility charges, sales taxes, and temporary levies that quietly renew. If you own the bonds where you live, you take the hit twice. Your portfolio marks down as spreads widen, and your household cash flow tightens as the city closes the gap. Here's how it unfolds. Analysts flag rising fixed costs and limited revenue flexibility, and shift the outlook to negative. Underwriters widen price talk on a refunding that used to pencil savings. The city pushes ahead. Maturities don't move because hopes did. The deal clears at a higher coupon. That locks a decade of extra interest into next year's budget. Spreads drift wider in the secondary, so your CUSIPs mark lower before any payment is missed. You haven't lost a coupon, but your total return just turned red. Budget triage starts the next week. Finance staff draft mid-year fixes. A modest mill rate bump, a water base charge increase to protect coverage, a renewal of last year's temporary public safety levy. Departments freeze hiring. Library hours shrink. Paving contracts get deferred a season. Residents feel it in slow, granular ways. Longer 911 hold times, fewer bus runs, more potholes, and in one big way when the bill arrives. Now the loop closes. Services slip while costs rise. Property owners appeal assessments. Some businesses shelve expansions. Assessed value growth trails inflation. With less real base, the next bond sale prices even wider. The city pays more to borrow as it collects less. The ratings language hardens. Pressure on revenue performance, elevated fixed costs, and the negative outlook lingers. The market doesn't wait. Benchmarks move. Funds trim exposure to stay within quality bands, selling what trades and leaving weaker paper behind. Microstory. Monday morning, the school CFO opens refunding results. The savings the board presented last month evaporated in the concession. By Wednesday, the superintendent extends a hiring freeze and postpones a curriculum buy. Friday, your property tax notice lands with a line item tagged Debt Service Stabilization. The district's rating letter didn't change, but your payment did. Meanwhile, essential service systems must defend covenants. The water authority's chemicals and energy are up, and capital is front-loaded after a winter of breaks. To keep debt service coverage above 1.5x, the board passes a base charge increase that doesn't count against state levy caps. It reads small, $5 to $8 a month, but it stacks with city fees and county assessments. Revenue bonds look stable because they can raise rates. The payer is you. State policy sets the ceiling. Levy limits and assessment caps constrict how fast property taxes can rise, even when fixed costs surge. Councils pivot to fees, fines, and special assessments that skirt caps. Ratings shops call this willingness and ability to raise revenues. Ability is throttled. Willingness shifts to regressive tools. Investors see stability in coverage and reserves. Households see shrinkflation in services plus a higher monthly nut. Insurance stress magnifies it. Premiums jump in hazard corridors. Some carriers exit. Disposable income shrinks. Sales tax softens. Housing turnover slows. Appeals rise. Assessed values flatten at the margin. The same pension dollar and higher debt carry now consume more of a weaker base. Issuers borrow to bridge timing gaps, adding leverage in the very moment the base sags. The negative outlook persists. Your Muni fund trims higher quality names to meet outflows, and the NAV recovery you expected takes longer. If you live where you invest, keep it small. Cap home state exposure. Prefer essential service revenue credits with real rate-setting autonomy and proven coverage over general funds boxed in by caps. Watch outlooks like smoke alarms. A negative outlook is a price signal, not just a label. And remember the sequence. Language changes, pricing widens, budgets triage, taxpayers pay, long before any default talks begin. The three-step audit: credit, geography, revenue source. Start with credit. Letters matter, but the words around them move prices. Pull the latest rating and outlook for each holding, Moody's, S&P, or Fitch, and treat a negative outlook or watch as a smoke alarm. A stable A with thick reserves beats a wobbling AA on negative outlook. Then find the fixed cost load, debt service, pension, and OPEB contributions as a share of revenue. If that sum is crowding the general fund, you're financing yesterday's promises with tomorrow's taxes. Context matters. The national average pension funded ratio is around 81.4% today. Issuers drifting below roughly 70% are in the red flag zone. Open the ACFR and go straight to the pension note. You're hunting four tells. 1. The funded ratio trend, not the single snapshot. Under roughly 70% and falling is a red flag. 2. Contribution discipline. Did the employer pay 100% of the actuarially determined contribution for the last 5 years? Mrs. Stack into stress. 3. The assumed return and discount rate sensitivity. If a 1-point drop explodes liabilities, the balance you saw was fragile. 4. Amortization terms, closed and shorter pays principal, open and rolling punts it. Cross-check OPEB for pay-as-you-go exposure that can creep. Next, reserves. Unassigned general fund balance, as a percent of expenditures, tells you how much shock the issuer can absorb. Green is policy level or better, with a history of replenishment after draws. Yellow is thin but recovering. Red is below policy with no plan. Read the liquidity footnotes. Some reserves are restricted or one-time. You want cash, not promises. Now, legal security. A full faith and credit go is broad, but state levy caps can mute it. Lease or subject to appropriation structures add politics to payment. Dedicated taxes, sales, income, hotel, swing with cycles. For each bond, write down the pledge, any additional bonds test, and reserve requirements. Clarify if there's a debt service reserve fund in cash, and whether it's springing or always funded. Tools you can use today: EMMA, the free SEC-designated public repository, for official statements, continuing disclosures, and posted rating actions. Your broker's portal for rating changes. Preview pages from the agencies for Outlook language. If you own funds, download full holdings, not just top 10s, and tally BBB and unrated buckets. Style drift hides there. Shift to geography. Map where your risk lives. Add up state and metro weights across all bonds and funds. If any single state tops 20%, and especially if it's your home state, cap it. You don't want your job, house, and coupons tied to the same legislature or hazard map. Then overlay climate. Recent offering documents now include hazard disclosures, coastal surge, riverine flood, wildfire, extreme heat. You're looking for specifics, updated FEMA maps, sea level scenarios, fire risk overlays, and named adaptation projects with timelines and funding sources. Thin boilerplate is a tell. Remember, after the 2017 to 2018 California wildfire seasons, economic losses approached $250 billion, and S&P cited climate exposure in outlooks and downgrades, and insurers have been pulling back. Premiums have risen about 21% since 2015. Insurance is the new budget variable. Check local news and state insurance bulletins for carrier withdrawals and premium spikes. Rising homeowner costs mean assessment appeals, slower sales, and less disposable income, which shows up in property and sales taxes. If state residual markets are taking share, ask whether prices reflect risk or politics. Both can pinch. Demographics decide elasticity. Pull 5 and 10-year population trends and break them by age cohorts. A rising over 6.5 share without growth in working-age residents narrows capacity. Track dependency ratios. More non-workers per worker means thinner base. Compare assessed value growth to inflation. Subinflation is a slow cut. Add employment anchors, healthcare, higher ed, logistics, government versus single industry towns. Policy matters too. State levy, rate, and assessment caps limit maneuvering right when fixed costs surge. Pew's work shows caps are near universal. Know your issuer's box. Layer climate and insurance. Carrier withdrawals from hazard corridors and higher premiums can erode assessed values and sales taxes, compounding demographic drag. Finish with revenue source, the engine paying you. For GOs, you're relying on broad taxing power constrained by policy. Look for voter support history on overrides and a record of replenishing reserves. For revenue bonds, it's coverage and control. Write down historical debt service coverage. About 1.5x or better through stress is a good sign, while sustained coverage below roughly 1.3x is a red flag, and whether the board has true rate-setting autonomy or needs state approval. Evidence beats language. Scan board minutes for actual mid-year hikes when coverage dipped. Sector specifics keep you honest. Water and sewer credits with automatic pass-through mechanisms, rate stabilization funds, and diversified customer bases are sturdy. Target coverage at or above about 1.5x through stress, and treat persistent sub 1.3x as a red flag. Power systems with flexible fuel and contracted load hold up when heat spikes demand. Hospitals are labor and payer mix sensitive, require days cash on hand and strong master trust indentures. Higher ed needs stable enrollment and manageable discount rates. Auxiliary revenue volatility bites. Land-secured deals live or die on value to lien and absorption. Seasoned tracks beat glossy dirt. Tie it all together with a rule you'll keep. If Step 1 throws a red, negative outlook, sub 70% pensions with ADC misses, thin reserves, then Step 2 must be clean, diversified economy, favorable demographics, credible adaptation funded now. If geography is challenged, hazard corridors, insurer retreat, tax caps, then Step 3 must be bulletproof. Essential service revenues, demonstrated rate actions, coverage comfortably above 1.5x, and cash reserves in place. 2 reds anywhere. Exit. 1 red offset by multiple greens and improving trends. Size it small and set alerts. Set your cadence. Quarterly, recheck ratings and outlooks. Semi-annually, refresh geography and demographics. After every continuing disclosure, update coverage, reserves, and rate actions. Put call date alarms on premium callables. For funds, monitor duration bands, BBB share, state concentrations, and any tender option bond usage. Keep MMA as your default source for official statements and continuing disclosures. Behavior in stress is your North Star. Own the credits and managers who already did the hard things when it counted. Red flags and green lights, quick heuristics you can apply. Let's make this fast, visual, and usable. Think red, yellow, green, then act with size and timing, not vibes. Start with hard reds. A negative outlook or negative watch from any major rater is a red. Treat it like a smoke alarm. Prices usually move before headlines. A pension-funded ratio under roughly 70%, especially if the trend is down, and a history of paying less than 100% of the actuarially determined contribution is red. Add a red for shrinking 5 and 10-year population trends, or assessed value growth trailing inflation. That signals a tax base that isn't keeping up with fixed costs. If levy, rate, or assessment caps box in revenue, and Pew shows every state imposes some limit, that's another red when paired with rising fixed costs. Insurance withdrawal is a quiet red too. Carriers exiting wildfire or flood corridors and double-digit premium hikes telegraph stress to property values and sales taxes. For revenue bonds, sustained coverage below about 1.3x is red, especially if board minutes don't show actual mid-year rate hikes when coverage dipped. Open, rolling pension amortization that never kills the principal. Red, smoothing losses for too long. Red, in funds, more than 30% in one state, a jump in BBB and unrated exposure, heavy tender option bond usage, or clustered call dates that create extension risk. Those are reds. If your home state is also your biggest fund weight, mark it red on concentration alone. Now yellows, the proceed, but size small signals. A stable rating with thin reserves is yellow if there's a track record of replenishment after draws. A funded ratio in the mid-70s trending up is yellow if the employer pays the full ADC. Mild outmigration is yellow if incomes and assessed values are still growing above inflation. Climate exposure is yellow when disclosures are specific and adaptation funding is identified and scheduled, not wished for. For revenue credits, 1.3x to 1.5x coverage with demonstrated, timely rate actions is yellow leaning green. In a fund, 15% to 25% single state weight is yellow if other states balance it and BBBs are capped. Greens earn their color through behavior. Stable to positive outlooks, reserves at or above written policy with documented replenishment, and conservative pension assumptions, a lower discount rate, closed, shorter amortization are green. Economic diversification is green. Multiple anchors across healthcare, higher ed, logistics, tech services, and government. For revenue bonds, greens mean real rate-setting autonomy, coverage consistently above 1.5x through stress, and cash-funded debt service or rate stabilization reserves. Board minutes showing mid-year increases when coverage softened? Green. For funds, greens are explicit risk limits, caps on BBBs and single-state exposure, tight duration bands, minimal leverage, full monthly holdings, and low fees. Use a simple decision rule. 2 reds in any category, credit, geography, or revenue, exit or slash size. 1 red offset by multiple greens and improving trends? Keep it small, set alerts, and define what fixes it. A full ADC streak, a reserve rebuild, a completed rate action. Mostly greens with clean disclosures and a history of doing the hard things? That's core, but still sized under concentration caps. Microchecks keep you honest. Read the ACFR sensitivity table. If a 1-point discount rate drop explodes liabilities, darken the shade. Scan the 5-year contribution schedule. 5 for 5 on ADC is green. 3 for 5 with a catch-up is yellow. Repeat misses are red. Pull population by age cohort. A rising over 65 share without working age growth moves a color down. Compare assessed value growth to CPI. Subinflation shifts yellow to orange. Structure can flip colors. Premium callables clustered in a single year are yellow in COM tapes and red in rising rate regimes, extension risk. Hertz. TOBs inside a fund are a hidden red if you don't want leverage. A national fund becomes yellow to green if no state exceeds 15% and BBBs are hard capped below 10%. Last, demand proof. Greens aren't labels, they're actions. Full ADCs paid, reserves rebuilt after draws, adaptation projects funded and delivered, mid-year rate hikes when coverage dipped. Words in an offering document are neutral. Behavior under pressure is your signal. Positioning strategies, safer access to tax-exempt income. Let's build something that pays you through rough regimes without drafting your wallet for bailouts. Start with time over yield. A short to intermediate ladder, 1 to 7 years, in high-quality paper buys you options. When rates move or spreads widen, maturities roll, and you reinvest at better terms. Keep call dates staggered so you don't discover that half your portfolio extends when the next rate shock hits. Make the core boring and verifiable. Anchor with essential service revenue bonds, water, sewer, power, where boards have true rate-setting autonomy. Coverage has stayed at or above roughly 1.5x, 1.7x in past stress, and cash reserves are real and funded. Read board minutes. You want evidence of mid-year rate votes when coverage softened. Check for automatic pass-throughs, indexing to chemicals, energy, or inflation that shorten political lag. For power, confirm fuel flexibility and contracted load diversity. For water, locate drought plans and funded pipe replacements already underway. Go exposure belongs as a satellite, not the core. If you add it, demand conservative pension behavior. Lowered discount rates, closed amortization, full actuarially determined contributions paid across years, and reserves at or above policy with replenishment history. Prefer issuers with voter support for overrides. Willingness matters when state levy caps throttle ability. If you use funds, pick mandate before brand. Choose national, high-quality strategies with hard limits. Single-state exposure capped near 15%, BBB and unrated exposure capped low, explicit duration bans, minimal or no tender option bond leverage, and redemption in kind only as a last resort. Download full holdings, not just the top 10. Verify the BBB bucket, callable share, next call clusters, and state weights. Check stress windows, 2013's taper tantrum, March 2002, and the latest rate spike, to see if duration drifted, BBBs climbed, or cash was raised proactively. Don't double stack your life. If your job and home are in one state, avoid heavy exposure to that state's bonds. Single-state tax perks vanish fast if spreads widen and your property taxes, utility-based charges, and fees rise at home, especially as insurers retreat from hazard corridors and premiums trend higher. A national sleeve spreads policy, climate, and demographic risks. Blend taxable when math supports it. In some brackets and rate regimes, short, high-grade taxable corporates or agencies can deliver similar after-tax income with cleaner credit stories. Pair them with your Muni ladder to keep duration in range without reaching into BBB Munis for a quarter point you'll regret. Structure is half the battle. Favor non-callables or short calls inside your 7-year horizon. Premium callables look fine in calm markets. In rising rate regimes, calls don't come and duration jumps. Keep average portfolio duration firmly in your chosen band. If it drifts by more than half a year, harvest calls and reinvest shorter. Hold a cash buffer, 2 to 4 quarters of portfolio income. It's not dead money. It's your right not to sell into a thin tape. In funds, prefer vehicles with larger asset bases, clean histories of handling outflows, and lines of credit to bridge redemptions without dumping the best bonds first. Low fees matter. They reduce the pressure to stretch for yield that later behaves like risk. Use explicit tripwires. If any holding flips to negative outlook, cut the size in half and review pension notes and reserves. If an issuer's funded ratio slides below roughly 70%, with today's national average around 81.4%, or ADC discipline breaks, exit unless governance changes show up in writing. If a fund's BBB bucket rises more than 3 points quarter over quarter, or single-state weight breaches your cap, trim. If your ladder's next call concentration exceeds your annual maturity roll-off, rebalance to smooth. Tax location helps. Put the riskier, longer, or BBB-tilted pieces inside tax-advantaged accounts, and keep your taxable account for the highest quality, shorter tax exempts. That way, pruning risk doesn't trigger a tax bill that traps you in place. Consider separately managed accounts if you want transparency without DIY. Set rules you can audit. Minimum rating by sector, maximum issuer and state weights, climate exposure filters, pension health thresholds, callable limits, and duration bands. Demand monthly holdings and explanations for any exception. Finally, size ambition to resilience. Avoid concentrated bets. No state above your cap, no sector sleeve over your limit, no single issuer more than a small percentage. Accept a slightly lower headline yield for proof of behavior. Full ADCs paid, reserves rebuilt, adaptation funded, rate actions taken. You're building cash flow that survives dull years and bad years. The yield you keep beats the yield you chased, and then subsidized with your taxes. Rate regimes and Muni math. How? Prices break before defaults. Here's the uncomfortable truth. Your Muni can drop hard without a single missed coupon, and it starts with rates. Duration is the sensitivity dial. A bond with an 8-year duration typically falls about 8% when market yields rise 1 percentage point. That loss shows up before any credit headline, because price is discounting time value first, solvency second. Convexity pushes it further. As yields move, duration itself changes. Premium callables that everyone assumed would be redeemed in 5 years suddenly don't get called when rates rise. They morph into long bonds. That extension turns a tame duration into a jumpier one at the worst moment. The number on the fact sheet was a sunny day estimate. Now layer spreads. Munis don't float on treasuries alone. They ride a credit spread that widens in stress. When risk appetite fades or redemptions hit funds, buyers demand more yield. A 10-year AA that traded near 70% of treasury yields can quickly climb toward 85 to 95%. That spread widening stacks on top of the rate move, compounding the markdown on perfectly current paper. Liquidity is the silent amplifier. The muni market is dealer intermediated and thin. In outflow waves, funds sell what trades, usually larger, higher quality bonds, because they must meet cash. That resets reference levels down the scale. Weaker CUSIPs follow on marks even without prints. Bid-ask gaps widen, so if you sell, you cross a bigger spread. If you hold, your statement still marks to the last low trade. Total return tells the truth. Coupons feel steady, but they can't outrun math. A 4% tax-exempt coupon doesn't offset a 10% price drop from duration and spread beta. If you're drawing income, you might be liquidating principal to keep checks level. That's how SAFE turns into silent capital loss while every payment arrives on time. Watch the sequencing. Macro data lifts rates. Duration marks you down. Funds face redemptions, spreads widen. Then credit language shifts, rising fixed costs, narrowing flexibility, and prices gap again. By the time an outlook flips negative, much of the damage is already booked. Markets price the path, not the obituary. Structure is the lever you control. Clean, non-callable bonds inside your horizon behave like their stated duration. Premium callables packed with near-term calls don't. They extend when you least want them. In rising rate regimes, extension risk turns a tidy ladder into a drag unless call dates are staggered and maturities roll every year. In falling rate regimes, reinvestment risk bites. Calls accelerate and you're forced down in yield. But that's the easier problem to solve. Fund behavior matters. Mandates labeled intermediate can drift long through premium callables. BBB sleeves creep higher to defend distributions. Tender option bond leverage amplifies both duration and spread shocks when volatility spikes and financing tightens. You feel it as a deeper drawdown and a slower recovery because the best bonds were sold first to raise cash. Practical gauges help you stay ahead. Track muni to treasury ratios across the curve. High ratios signal better entry points. Low ratios warn you not to stretch. Watch primary concessions. Bigger concessions mean buyers want protection. Compare your portfolio's drawdown to its stated duration. A loss bigger than the math implies likely means extension risk or sneaky spread beta. If a fund underperforms peers in every stress window, that's a habit, not bad luck. Act on triggers, not feelings. If rates rise 50 basis points and your intermediate sleeve falls like a long fund, trim call-heavy positions that just extended and reinvest shorter, cleaner structures. If spreads widen broadly, harvest tax losses and rotate up in quality. Sell names the market will punish next, and by the ones it rewards first on a rebound, typically essential service revenue credits with real rate power and thick coverage. Keep optionality. A 2 to 4 quarters cash buffer lets you wait for better prints instead of hitting wide bids. Duration bands you actually enforce, say 3 to 6 years, prevent slow drift. Concentration caps stop a single state, sector, or structure from dictating your outcome when regimes shift. Finally, remember the order of risk. Time and liquidity break prices before credit does. Pensions, climate, and demographics decide who pays over years. Duration and spreads decide your mark this quarter. Build for both. Shorten where you must, simplify calls, own coverage you can verify, and treat yield as payment for risk you understand. Not a consolation prize for surprises you didn't. The 24-hour playbook. Implement the audit now. Set a 24-hour clock. By this time tomorrow, your muni sleeve will be tighter, cleaner, and easier to sleep on. Hour 1. Gather everything. Statements, CUSIPs, fund tickers, maturities, coupons, call dates, pledges, go lease, or revenue. Build one sheet with columns for rating, outlook, watch. Status, state, sector, duration, callable yes/no, next call, and coverage if revenue-backed. Use YEMME, the free SEC-designated public repository, for official statements, continuing disclosures, and posted rating actions. Hour 2, ratings triage. Pull the latest Moody's, S&P, or Fitch entries. Letter, Outlook, and any watch. Treat negative outlook like a smoke alarm. Color code, green for stable, yellow for stable with thin cushions, red for negative outlook/watch. Set change of rating alerts on EMMA free, SEC designated, and your broker portal for every yellow and red. Hour 3, pension truth. Open the ACFR. In the pension note, log funded ratio trend, assumed return, 5-year employer contributions versus ADC, amortization method, and the 1-point discount rate sensitivity. Under roughly 70% funded with ADC misses, red. Closed and shorter amortization with 5-for-5 ADCs, green. Keep today's national context in mind. Plans average about 81.4% funded. Outliers below 70% deserve heightened caution. Hour 4, fixed costs and reserves. From MD&A and notes, add debt service plus pension and OPEB as a share of revenue, and unassigned general fund balance versus policy. If fixed costs crowd the budget or reserves sit below policy without a rebuild plan, shift the color a shade darker. Hour 5, legal security. For each CUSIP, write the pledge in plain English. Full faith and credit subject to levy caps, lease appropriation, or dedicated revenue. Capture additional bonds tests, rate covenants, reserve requirements, and whether the DSRF is cash funded. Political steps in the payment chain mean more yellow. Hour 6, geography map. Some state exposures across all bonds and funds. Cap any one state, especially your home state, at a hard limit you can live with. Overlay hazard risk, riverine flood, coastal surge, wildfire, heat. Use recent official statements for climate disclosures and state portals for corroboration. Issuers without climate-adjusted reserves or funded adaptation. Mark them down. Hour 7, insurance scan. Check state insurance bulletins and local news for carrier withdrawals and premium spikes. Rising premiums mean assessment appeals, slower sales, softer sales tax. Note where residual markets have stepped in at higher prices. If insurance is wobbling, your tax base is wobbling. Hour 8, demographics pass. Pull 5 and 10-year population change, dependency ratios, and assessed value growth versus inflation. Add school enrollment trends and facility utilization for districts. A rising over 65 share without working age growth, and AV growth below CPI, narrows capacity, color accordingly. Hour 9, revenue engine. For revenue bonds, log historical coverage, board rate setting autonomy, and evidence of mid-year rate votes when coverage dipped. Look for rate stabilization funds and cash-funded reserves. Aim for about 1.5x or better coverage through stress. Sustained sub 1.3x is a red flag. For hospitals and higher ed, add days cash on hand, payer mix or enrollment. Thin coverage without decisive rate moves is a flag. Hour 10, structure sweep. Identify premium callables and next call clusters. Estimate effective duration to the worst call. In rising rate regimes, assume extension. Smooth any single-year pileups. Prefer non-callables or short calls inside your horizon. Hour 11, fund autopsy. Download full holdings. Tally single-state weight, BBB and unrated buckets, callable share, TOB and derivatives usage, average duration versus mandate. Compare behavior in stress windows, 2013, March 2002, and the latest rate spike. If drift shows up, plan trims. Hour 12, set hard limits. Write your rules. Max 15% per state if you live there, lower if your job's there too. Hospitals under 10%. Minimum A, except essential service revenue with 1.7x coverage. Duration band 3 to 6 years. Callable share capped with staggered next calls. No TOB leverage. Hour 13, cut risk. List sells and trims. Any negative watch without offsetting strengths sub 70% pensions with ADC misses. Reserves below policy with no plan. Funds with drifted duration or BBB spikes. And call clusters that just extended. Harvest losses and rotate up in quality and structure. Hour 14, rebuild core. Add essential service revenue credits with real rate power, consistent 1.5x. 1.8x coverage through stress, cash reserves, and board minutes showing actual rate moves. Ladder maturities 1 to 7 years, smooth calls, and keep duration inside band. If using funds, pick national, high-quality mandates with explicit caps and low fees. Hour 15, tax location and cash. Park riskier or longer pieces in tax-advantaged accounts. Keep highest quality, shorter tax-exempts taxable. Hold 2 to 4 quarters of portfolio income in cash, so you never hit a wide bid. Final 9 hours. Execute in waves to respect liquidity. Set calendar alerts, quarterly ratings/outlooks, semi-annual geography/demographics, immediate reads after continuing disclosures for coverage, reserves, and rate. Actions. Add call date alarms, reserve policy changes, and fund BBB/state weight tripwires. Document exceptions. If you keep a yellow or red, write the fix and a deadline, full ADCs, reserve rebuild, completed adaptation project, rate vote. If it doesn't happen, sell. You didn't chase yield. You bought time, control, and proof. Meaning and mindset. Redefining safe income. Safe isn't a label on a tax form. It's a system that keeps paying you when the world isn't cooperating. When rates jump, spreads widen, pension math tightens, insurers retrench, and voters balk. Safety is proof. Conservative assumptions, cash you can verify, covenants that actually bite, and boards that raise rates when coverage dips. It's also humility. Accepting a little less yield today to avoid subsidizing somebody else's optimism later with your principal and your property tax bill. Start by paying for clarity over comfort. Transparent issuers publish lower pension discount rates, closed and shorter amortization, 5-for-5 actuarially determined contributions, and capital plans tied to funded dollars, not placeholders. Their climate appendix isn't boilerplate. It maps hazards to specific projects and reserves. Those aren't vocabulary words, they're behavior. You're trading a handful of basis points for the right kind of boredom. Respect where the power really sits. Essential service revenue systems with true rate-setting autonomy, rate stabilization funds, and 1.5x, 1.8x coverage through stress are built to flex. General funds boxed in by levy caps and rising fixed costs rely on timing, goodwill, and cleverness. Cleverness is fragile. Flex is reliable. When spreads gap, credits with demonstrated rate actions and replenished reserves get buyers first, recover faster, and trade tighter sooner. Diversification isn't a pie chart, it's independence of failure. Don't stack job risk, home risk, climate risk, and portfolio risk inside one state line because the tax break looks tidy. Spread geography, sectors, structures, and managers. Cap single state exposure, especially where you live. Cap sector sleeves that rhyme. Hospitals and senior living carry the same labor and payer pressures. Land-secured paper echoes housing cycles. One policy change or weather pattern shouldn't decide your year. Structure is a decision about your future self. Premium callables boost today's coupon and ambush you in rising rate regimes when calls don't come. Non-callables or short, staggered calls inside your horizon won't surprise you. A 1 to 7 year ladder gives you annual exits. Duration bands you actually enforce keep drift from turning an intermediate sleeve into a long one when you weren't looking. Treat funds as partners you audit, not black boxes you trust. Mandate before marketing. Hard caps on BBBs and single state weights, minimal leverage, tight duration bands, full monthly holdings, and low fees. That's a process you can live with. Look backward at stress windows to see real behavior. Did they raise cash, hold their bands, and protect quality, or chase distribution rate optics and sell their best paper into outflows? Reframe yield as a byproduct of resilience. A quarter point you find by sliding into callable, concentrated, or leveraged exposure isn't spread. It's a fee you'll pay later when liquidity thins. The premium you want is in governance quality, pricing power, and verifiable reserves. The things markets reward first on a rebound and punish last in a sell-off. Yield that behaves beats yield that disappears when spreads move. Make maintenance your mindset. Quarterly, read rating outlooks and reserve positions. Semi-annually, update climate, insurance, and demographics. After every continuing disclosure, check coverage and rate actions. Set tripwires you'll honor. Negative outlook halves position size, BBB share spikes trigger trims, duration drift gets cut back, call clusters get smoothed. Document exceptions with deadlines. If the fix doesn't happen, sell. Above all, align what you own with how you live. If your community faces levy caps, insurance shocks, and aging infrastructure, don't mirror that risk in your portfolio. Support realistic rate actions and honest pension funding as a voter, and buy credits with the same habits as an investor. Safe is doing the unglamorous thing early, so you don't do the desperate thing late. That's how income stays income and doesn't become a slow transfer from your brokerage account to your utility bill. Your tax break isn't protection. It's a discount to the real risk. Safety isn't tax-free. It's credible cash flows backed by governance, pricing power, and reserves that bend without breaking. Manage risk before chasing yield. Audit pensions first. Funded ratio trend, 5-for-5 ADCs, closed amortization. Verify reserves and coverage. Cap home state concentration, and prefer essential service revenues with real rate authority and consistent 1.5x plus coverage. If you want state-by-state screens, sector, clinics, and live filings decoded into red, yellow, green calls, subscribe now and cue the next deep dive. Next video, pension autopsies, how to read ACFR notes, discount rate sensitivity, and legal hierarchy so you don't fund tomorrow's tax hikes with today's safe yield. Audit today, reposition this week, and keep the yield you can actually spend. What's next? Make this a system, not a one-off. Next video, pension autopsies. Open ACFRs with us, read discount rate sensitivity, amortization terms, and 5-for-5 ADCs, and map legal hierarchy so you can rank credits before the market does. Coming up, climate corridors, hazard overlays, insurer withdrawals, premium shocks, and how adaptation funding, or denial, shows up in spreads. Sector spotlights, hospitals, transit, higher ed, land secured, water and power. What to demand, days cash, coverage, covenants. What to avoid. Tools walkthrough, EMA pages that matter, coverage tables, rate actions, and where covenant waivers hide. Portfolio clinics, submit anonymized holdings. We'll grade pensions, reserves, insurance stress, and demographics, and propose cleaner swaps. Subscribe and turn on alerts so you don't fund tomorrow's tax hikes with today's safe yield.